Imagine a world where every business venture, no matter how grand, carried the potential to ruin you completely. Your personal home, your savings, your family's future, all on the line with every investment. This was largely the reality for centuries, until a pivotal concept changed everything. Limited liability, when applied to early companies, dramatically reshaped them by reducing the personal financial risk for investors. This crucial innovation allowed entrepreneurs and merchants to pool capital for large-scale projects without fearing that a business failure would bankrupt them individually. It was a catalyst for economic growth, enabling ventures for beyond the scope of individual wealth. The core mechanism behind this impact is straightforward. Before limited liability, most business structures like partnerships meant that each owner was personally responsible for all the company's debts. This unlimited liability meant that creditors could pursue an owner's personal assets, such as their house or land, to satisfy business obligations. Limited liability, however, established a legal firewall between the company and its owners. This meant an investor's potential loss was capped at the amount of capital they had invested in the company, protecting their personal wealth from business debts and lawsuits. This shift from unlimited to limited liability had profound practical implications. It encouraged more people to invest in nascent joint stock companies, which were the precursors to modern corporations. With reduced personal risk, investors were more willing to finance ambitious but risky expeditions like global trade voyages, colonial settlements, and large infrastructure projects. Instead of needing just a few wealthy patrons, companies could attract smaller investments from a broader base of individuals, significantly expanding their capital-raising capabilities. A key example of this principle in action is seen with the early East India Companies. The British East India Company and the Dutch East India Company, both established in the early 17th century, were among the first to fully leverage limited liability. Investors could buy shares in these ventures knowing that if a ship sank or a trading post failed, their personal fortunes would remain secure. This structure allowed them to amass vast amounts of capital, for more than any individual or small group of partners could provide, which was essential for funding their extensive and often perilous global operations. In essence, limited liability transformed the very nature of economic enterprise by making investment less terrifying and more accessible. It provided a framework for aggregating immense capital from diverse sources, fostering an environment where large-scale, complex commercial and industrial undertakings could flourish. This paved the way for the Industrial Revolution and the modern corporate world we recognize today, all thanks to that fundamental separation of personal and business finances.